Hello, I'm Don Mitchell. Welcome back to Business Basics. Today we'll continue speaking about ways to reduce investment intensity for you and your stakeholders. In this case, our topic in Lesson 50 will be choose the ideal level for issuing equity. I'd like to begin with a very long quote from the Bible, but one I think will set the stage for this discussion. This is from the book of John, chapter 21, verses 4 through 12 in the New King James Version, and I quote, "But when the morning had come now, Jesus stood on the shore, yet the disciples did not know that it was Jesus. And Jesus said to them, 'Children, have you any food?' They answered him, 'No.' And he said to them, 'Cast the net on the right side of the boat, and you will find some.' So they cast, and now they were not able to draw it in because of the multitude of fish. Therefore that disciple whom Jesus loved said to Peter, 'It is the Lord.' And when Simon Peter heard that it was the Lord, he put on his outer garment, for he had removed it, and plunged into the sea. But the other disciples came in the little boat. They were not far from land, but about 200 cubits, dragging the net with fish. And as soon as they had come to land, they saw a fire of coals there, and fish laid on it, and bread. Jesus said to them, 'Bring some of the fish which you have just caught.' Simon Peter went up and dragged the net to land, full of large fish, 153. And although there were so many, the net was not broken. Jesus said to them, 'Come and eat breakfast.'" As lessons 47, 48, and 49 point out, most companies that have a very high profit margin, large profits, little need to reinvest, and a great deal of cash often pick poor alternatives for handling their cash. In this lesson, we look at how to understand the optimal price levels and amounts of issuing equity in terms of the more attractive investment choices that are not usually considered. This lesson complements Lesson 49 concerning the optimal debt levels for extracting excess cash from the balance sheet. A high-margin, rapidly growing enterprise that requires few new investments often sees its equity value explode upward. That's because most equity valuation methods are built around estimating future cash flows for 20 years and discounting them back to the present by using the current interest rate plus a little added premium for the volatility of equity market shares. And then I include a fairly complex example, which is looking at a company that would grow in sales 40% a year, profits at 40%, cash flow at 40%, but sales to net assets would be a very high ratio of 25, with a return on equity of 1,000%. And what we see here when we do this is that by year 20, the cumulative cash flow, if you started out with only making $5,000 a year, would be $3 million. A typical way of calculating equity value also adds a residual value equal to the discounted present value of a normal market multiple of the annual cash flow generated in the 20th year to the 20 years of cumulative discounted cash flows. With this calculation, the equity value is about $10 million, assuming a present value of 10 times cash flow multiple residual in the 20th year. If we compare that equity value to our year one cash flow of $5,000, the comparison gives us a valuation multiple of more than 2,000 times year one cash flow. Now, isn't that ridiculous? But that result follows from using the valuations of many so-called sophisticated investors. Valuation-sensitive investors who are more conservative simply slow down the rate of future growth, but they still come up with gigantic multiples of today's cash flow. Such, quote, conservative, end quote, investors would probably be willing to pay 200 times the year one cash flow. To demonstrate the foolishness of such conclusions, look at the ratio from other perspectives. What's the current cash flow return on investment for an investor who pays so much? The current return for paying 2,000 times cash flow is 0.05%. Now that's pretty meager, I'm sure you agree. The return for paying 200 times cash flow in year one is 0.5%, also quite meager. However, such high valuations create interesting opportunities for companies. The organization's growth eventually slows down, interest rates and risk levels rise, and returns drop. The equity value of such an enterprise at such a future time might be only a few $100,000 instead of 10 million or more. What opportunity does this drop in equity value create? Well, you can repurchase any high multiple equity you sold at the later fair and much lower value. If enough time passes between the two occasions, you can earn, in the meantime, a great deal of money on the funds you raised by selling equity. Here's how such a sequence might look. Let's assume that you can sell 10% of the equity enterprise value of $3 million in the first year, leaving plenty of room for the most optimistic investor to perceive a, quote, bargain, end quote, relative to the valuation of $10 million and receive $300,000 less offering expenses of $50,000. You then have the use of that money for 20 years. If you earn 5% after tax annually on the money you raised for 20 years, your cumulative earnings after tax from having the $250,000 will exceed $300,000. If you can then repurchase the stock you originally sold for $300,000 after 20 years at the same price, you keep the more than $300,000 in earnings you gained from investing the equity sale proceeds. Now that's pretty nice. Let's assume that you have some attractive places to invest the money that will further stimulate the enterprise's growth and profitability while helping all stakeholders by decreasing their investments. You make such investments with the $250,000 proceeds from the equity sale in year one. That investment dramatically increases company earnings and cash flow performance in the future and the enterprise's value over its life. Whenever the enterprise's equity is fairly valued relative to current performance, you can either borrow money to repurchase the shares you had sold earlier, or you can use any excess cash you build up along the way for the same purpose to retire those shares. What's the benefit of investing to make breakthroughs for your company and its stakeholders by first using high-priced equity? You don't have to be concerned that a future stumble leaves the enterprise with a fixed obligation that it cannot afford, such as borrowing money does. The more the enterprise's equity value drops in the future, the less money it takes to retire those shares. It's a natural way to reduce risk. What about the ethics of these actions? I suggest you not push selling for anything near the maximum equity price at any time. Allow those who purchase the new equity to calculate in their own ways that they're getting a big discount by buying a lower multiple than you could charge. Taking this approach will provide such equity investors an opportunity to later sell their shares to someone else at a profit. The organization continues to do well by making breakthrough investments. Each equity purchaser will make money. Applying the funds you receive in an optimal way reduces the risk that any stakeholder will not profit from any equity investments they make whenever such purchases occur. So what's the key point about picking the ideal level for issuing equity? Redesign your company's business models, methods of operating, use of facilities, ownership of facilities, breadth of product line and offerings to reduce investments by 96% for you and your stakeholders, creating lots of excess cash and benefits for all stakeholders. Then learn a lot at little expense about how excess cash might best be applied to the value chain through models that consider the effects of several variables on one another as well as on other stakeholders. Use the lessons of your analysis to consider how employing cash raised by selling highly valued equity could make an even better strategic option available that would avoid harmful cash flow buildups in your enterprise and reduce the risk of stakeholders not earning good returns, especially your shareholders. Your assignments are threefold. First, identify the 5 most significant effects from applying excess cash in order to provide more benefits that customers and suppliers want. Second, consider how such changes would affect your other stakeholders. Third, investigate how your business models, methods of operating, use of facilities, ownership of facilities, breadth of product line, and offerings could be shifted over time to be even more effective and make it easier for stakeholders in your company to identify better ways to operate with very little investment as a result of your sales of highly valued equity and wise application of the proceeds from the sale and any excess cash that your company produces. So I hope this lesson once again has opened your mind to some awesome, really interesting opportunities, and that you'll be back soon to hear the last 2 lessons of Business Basics. But in the meantime, may God bless you, your family, and all you do in the name of Jesus. Goodbye for now.